Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and the thing that's flashing on your screen is our WhatsApp number and email ID where you need to send us your financial portfolio queries. But then let's move on. Recently, a survey revealed that 61% existing mutual fund investors have invested in at least one passive fund. Of these passive funds, almost 87% of them have invested in passive funds through index funds, while 41% have exposures to ETFs. Now, report also says that passive funds have gained traction as its contribution to the total AUM has increased from merely 1.4% in 2015 to over 17% in 2023. So, is this the reason why fund houses are going the passive way, or is it just a herd mentality that investors are falling for? Let's discuss all of this. I have Kaustubh Belapurkar, Director, Fund Research, Morningstar Investment Advisor India, with me. Kaustubh, good evening and welcome to the show. So, what do you have to say about the trend? Is it just herd mentality, or investors are really following the Western pattern of investment, which is the passive way?
Sure. Hi, Kavita, and thanks for having me on this conversation. I think a very interesting point of discussion, right? Because when we think about the whole passive versus active debate that's obviously been boiling over in the Western countries, like you mentioned, for a decade or more, and clearly the data there is clearly showing that more and more money is moving towards passives in countries like the US. But when I think about the local context, right, there are various aspects to this. And more recently, obviously, we've seen a lot of action in terms of, new passive fund launches, increased assets or money coming into passives. But I think from an Indian ecosystem perspective, and this is true even for globally, it's never an active versus a passive debate. I think both are crucial for the market, right, from a mutual fund industry, and from an investor's perspective too. And I think a few things are very important to highlight and note here. So few things are happening, right? So one is there are newer asset managers who are getting licenses or launching funds in the country. And I think it's a healthy mix of both active shops and passive shops, right? So we've seen certain new asset managers come up who are very investment focused, active alpha shops, and they've launched their strategies over the past couple of years. At the same time, we have certain shops that are either been launched or rebranded or coming up very soon, whose focus is purely on technology and reach, right? And they've gone the passive way, where they want to get the low cost sort of investing across the length and breadth of the country. So I think both business models can work, and obviously it's dependent on the core competence of the asset manager that was looking to launch that, right? The other thing that's happening is existing asset managers who have large asset active bases are also augmenting their product sort of bouquet with adding passive strategies on if they didn't already have it, right? For two reasons. One is obviously look at SEBI's mandate of one fund per category. So most of them already have funds within that. So on the passive side, obviously you can launch index funds and be ready for or have a product available for an investor who's looking for a passive investing option within the various options that could be available to them. So I think that's the reason which has added a lot of sort of new fund launches, assets to the passive side. A few other important things to note. I think before the taxation change for debt funds, target maturity funds on the fixed income side. So predominantly we had equity passives to start with, but on the fixed income side, we've had a whole host of target maturity funds, especially when interest rates were volatile, and there was a lot of investor interest in those funds as well. And I think the last thing which we often forget, so obviously the assets have gone up significantly, like you mentioned, in excess of 16-17% of the industry, but still a large chunk of that comes from the EPFO, sort of mandates that come in the index ETFs. But that said, I think retail investor, HNI investor interest is definitely increasing. But like I started saying, it can be a symbiotic world where both active and passive funds exist. It happens even in a evolved market like the US. So India is going to be no different in that sense.
Exactly. But not necessarily, Kaustubh, it also means that investors are not trusting the fund managers now and their alpha gaining strategies. This is not to be translated in that way, right?
Oh, yes, absolutely. So I think the most important point, and like I was saying, that for an investor, it's not necessarily an active versus passive decision. Both of these strategies, even from an individual investor's portfolios, can definitely exist, right? And talking about alpha, I know there's been a lot of conversations and a lot of discussions about, has alpha vanished for Indian fund managers? I don't think so, right? I think, on a long-term basis over a market cycle, the good strategies can still continue to generate alpha. But I must acknowledge that, it was a much more free-flowing alpha world maybe 5-6 years ago in terms of, every single manager could beat the benchmark. Obviously, the rules for benchmarking have changed now with the total return index. SEBI's categorization also has made the investment focus, much more focused for the asset manager. So all of that what has that resulted in? The quantum of alpha that a fund manager can generate has probably reduced a bit in certain categories. We talk about large caps. The percentage of assets or the percentage of strategies that can beat the benchmark will also, that's also come down, right? That's obvious that's going to happen. But there's a very important reason why we think that, for instance, like markets like the US, it's become very increasingly hard for active managers to beat the benchmark. So when you think about it, typically only 10 to 15 to 20% in certain categories of the active funds beat their, passive peers, right? But even if I look at SEBI's data, which they published in the consultation paper earlier this year on expense ratios, what we can see is that, and again, it's important to acknowledge it's not beating a benchmark, but it's actually beating a passive peer, because remember there are costs involved in investing in the passive peer also. And I think a healthy number, over 5 years, I think it's about 65% over a 10-year. In fact, it is almost 75-80% of the active funds, are beating their passive or underperforming the benchmark by less than 1.25%, which is really the hurdle. So I think active management is here to stay, right? And I use the example of the US, and why I think that we're still far away from the US example is from a very important data point. Is when you think about how much do Indian mutual funds own of the entire equity market as a whole, right? Of the Indian equity market, it's about 8 to 9%, give or take a few basis points, right? In the US, the same number is 30%, right? So when we grow larger as an industry and assets become 20% of the market or more, that's when a greater number of strategies can struggle. But I think right now there's enough and more space for active managers to perform. But investors need to keep a few things in mind, is that there will be style headwinds for each active manager, which over the short term. So they have to ride that out and stay invested in the fund over a market cycle. And if they do that, and they've identified a good manager, just stay invested, and you will have a good, reasonable probability of making alpha over the benchmark if you've chosen the right strategy and stayed invested.
Kaustav, one more question and then we will take our viewer query. So the other question and the last question to you is, what is the reason behind new AMCs mostly launching passive funds? Is it just the interest that they want to take advantage of, or there's a specific strategy that these new AMCs or even boutique AMCs are opting?
Yeah, so again, I think passives are also a very compelling investing choice, right? And I mean, they're low cost, they track an index, right? So there's, definitely merit in certain types of investors or investors within their portfolio construct having passives available to them. For instance, if I'm a new investor, I'm not sure of which fund to pick within a category. I want to say, for instance, I wanted to buy a large cap fund, but I'm confused because there are 35-40 funds. And then what happens sometimes, it's called choice paralysis, that when you're presented with so many options, you just don't choose anything, or you make wrong choices and keep switching, right? To prevent that, then for a new investor or someone who doesn't have the time to make that choice or isn't working with an advisor or a distributor, then can perhaps, just to get exposure to the market, buy a passive fund, right? And that's what I think is the beauty of passives, where it's a very simple investing choice. And the newer AMCs who are tech enabled, looking to expand their reach to just beyond, not just to the the metros or the bigger cities, but beyond that, using their technology and the existing investor base, it becomes a very compelling investment choice that you can set up this platform where investors can get access to the index funds or ETFs at a very reasonable cost without having to worry about which active fund to buy, right? So I think that's really the way that a lot of these new AMCs will be looking at adding to their product bouquet.
All right, I think it's time up for this discussion, although I have a few more questions for you, but then I also have a viewer online waiting to get the portfolio answered. I have Mr. Naqvi. Hi, good evening, sir, and thank you so much. I think we took your question yesterday and there were some missing details that you added today and sent us the portfolio. I think Kaustubh has the question. These are the funds that you were talking about yesterday, Mr. Naqvi?
Yes, ma'am. Yes, ma'am.
All right, thank you so much for sending us your query. So,
Hi, ma'am. Yeah.
Kaustubh, that's the portfolio of Mr. Naqvi, and he will add rupees 1 lakh on quarter basis, and he has, okay, I think he has a lot of funds in his portfolio. You might just want to filter that out, Kaustubh. All right.
Yeah, and I think when I just look at the list of funds in the portfolio, and given the goal and the timeline that's mentioned, of about 5 years and 60 lakhs that Mr. Naqvi wants to collect, and just scanning through the list of funds, I think the first thing that stands out, and I would sincerely advise Mr. Naqvi to think about, is that there are a lot of thematic funds within this space. So I mean, there's a healthcare fund, there's a technology fund, there's an infrastructure fund. There's also an active momentum fund, which is more of a smart beta fund. Now, what happens with these strategies is that it can be a boom and bust, in terms of performance for these. And typically, we only, advise investors who can take a judicious call in terms of, assessing what the theme is, that, are healthcare companies, for instance, looking great and I want to take some exposure, or is technology now kind of bottoming out and it's probably a good time to come in? Because, it can be very, very fraught with timing risk, in the sense that, you may get in or get out at the wrong time. And without having that, ability to take a judicious call in a particular sector, for most investors, we advise to stay away from sectoral thematic funds. And even if you want to dabble, not more than 5-10% of your entire portfolio, right? So that's the first thing that I think, Mr. Naqvi needs to think about. So I would sincerely, think about that, maybe just exit these funds, or gradedly exit these funds, but, time is short, so probably, do the course correction now, right? The other thing, because it's a 5-year portfolio, and obviously in terms of just looking at what the current corpus, that's about close to about 5.5, 6 lakhs, and adding 1 lakh per quarter, I think we need to be a little realistic about the goal, because it's 5 years away. We have about 60 lakhs to get. So the first thing we'll need to think about is we'll actually need to de-risk the portfolio. So not just in terms of de-risking in terms of the sectors and themes, but also adding in more or less volatile sort of equity into the portfolio, along with some fixed income, right? So there is one fixed income fund that I see, a banking and PSU, but we might want to add more shorter duration strategies into the portfolio. But even for the equity portion, we want to build more allocation through a large cap and flexi cap, because these strategies will be a little less volatile than as compared to mid and small caps, where typically we look for at least a 7 to 10 year investing horizon, which clearly in this case, may not be possible, right? So I think that's one other thing that is very crucial to think about when constructing this portfolio. So I would recommend doing a fresh relook at the entire portfolio, definitely exiting the sectoral and thematic funds, maybe keeping a small and mid cap exposure to only 20%, build the rest through large and flexi cap stocks, in terms of, the funds that we like, Mirror Large Cap, ICICI Blue Chip, Kotak Flexi Cap. You already have a PPFS Flexi Cap. You can add some exposure to that. And very importantly, in terms of just doing the math on the portfolio, I think 1 lakh per quarter will not be enough to meet their end goal, because we have to also think about how when we come closer to the goal, we'll have to start cutting equity exposure. So I would think that about 1.5 to 1.6 lakhs per quarter is something that we need to start with now, and step that up by about 20% each year. I know it's a little aggressive, but we'll have to do it, because 5 years is otherwise not enough to kind of meet your entire goal. Either you'll have to, face a shortfall on your goal if we don't upfront these investments, or you'll have to extend your investing time period. So I think these are a few of the moving parts, which I would urge Mr. Naqvi to keep in mind, and kind of restructure the portfolio accordingly, and also set the investment expectations.
All right, all the best, Mr. Naqvi, with that. That was an in-depth analysis of your portfolio. But then we move on. Kaustubh, I have Jishnu on the phone line with me. Hi, good evening. How are you doing today?
Fine, I'm fine. How are you?
Hi, thank you so much for sending us your question. You have HDFC Multicap, Quant Midcap, Nippon India Midcap, Kotak Small Cap, SBI Small Cap, and SBI Liquid Fund in your portfolio. And
Right.
okay, you have sent your wife's portfolio as well. Okay, so your goals are joint goals, right?
Yes.
So 6 crores by 2043
Yeah. That's what you're planning.
from both of these portfolio, right?
Yes, combined.
In combination, yeah, combined. Okay, got it.
Yes.
All right, Kaustubh?
Yeah, so Kavita, I'll have to apologize because I don't seem to have the numbers in front of me for this one.
Sure. Okay.
But maybe if you can just read them
Do you,
off, I can
sure,
share
I
some
will.
thoughts.
So Jishnu has shared his portfolio and his wife's portfolio. The details will be flashing on the screen also. I'll just request the director to keep flashing the question in front of you. Jishnu has HDFC multi-cap, Quant mid-cap, Nippon mid-cap, Kotak small-cap, SBI small-cap in his portfolio. And his wife's portfolio has Quant flexi-cap, Mira Asset Tax Saver, SBI Magnum mid-cap, Nippon Mid Cap, Axis Small Cap, and ICICI Small Cap. They are investing almost 46,000 per month, and so far they have built 8.5 lakh in mutual funds, and they need to build 6 crores in 20 years, and they are also ready to step up their investment by 15% yearly. And he wants to know whether the current selection of funds is right, in tune with the goal that he's lined up for himself. And he's also looking at building an emergency corpus. He has separate RD also going on of 20,000 per month, and he will not need this money for next 18 to 20 years. So the goal of 6 crores by 2043 from both of these portfolio. Yeah.
Yeah, so I'll really, Kavita, sorry, I have to apologize, but I'm completely blindsided with this question because I haven't seen it before. So I don't
Okay.
think it'll be prudent for me to respond without having done some analysis on this.
Not a problem.
Yeah.
So I will just, okay, so can you just give us a rough figure of, accumulating 6 crores by 2043? What would be a monthly investment amount? If you could just calculate that and help the viewer. And Jishnu, we will take your question once again, maybe with Kaustubh itself, but in a later show. So how much should be the amount for 6 crores in 2043 that one should be investing every month? So far, he has 46,000, and he's also doing an RD of 20,000. I don't know if he should be adding that amount in an SIP also to raise it to almost 66,000 per month. But not bad. So far, he's built almost 8.5 lakh in mutual funds itself. So what is your calculation saying?
Yeah, if you allow me just 1
Sure.
minute, Kavita, sorry about that.
Sure. So, Mr. Jishnu, you had this portfolio checked by any financial planner, or this is just your research that you've done and added all these portfolio?
Yeah, actually, from my research, the only thing is like my portfolio will be like mostly concentrated on mid and small cap because my horizon is on
Exactly.
like 20
That's
years
what I
basis.
can
So
see.
yeah.
Yeah, that's what I can see. It's quite an aggressive portfolio.
Yeah, like 70% is mid and small. Most my
Sure.
my portfolio. So I achieve this mostly.
Okay.
So did I be reducing the small cap exposure and adding a new large cap or something like that?
Sure. So, Kaustubh, can I come to you?
So
Sure.
I'm just looking at the numbers now. So about 43,000 per month is the current SIP, if I'm correct, and a 15%
46, yeah.
step, 46, right? And a 15% step up is what's required. So I think we'll have to be a little more aggressive. I think if I just run the math on this, and currently about 46,000, and if we were to step it up by 15% every year, assuming a very reasonable return estimate of about 10%, and it can be more, but always err on the side of the caution. It'll probably result in a net portfolio value of about 7 odd crores at the end of 20 years, in 2043. Sorry, I just missed out. What was I think the goal was 8 crores, right?
6 crores in 2043.
6 crores. Okay. So I think then we're
yeah.
quite comfortable. So with the current 46,000 per month and, the 15% step up, we will, be very close to the ballpark that's required. Only a couple of things that I would keep in mind. right? Is one is that we can start with an aggressive portfolio, which I think Jishnu was also referring to. That given that you have a runway to 20 years, we can definitely have a slightly more skewed portfolio towards small and mid caps. But I would still recommend nothing more than 40%, even though it's a long-term investing horizon. Build the bulk of the portfolio with large caps. The other thing that we have to also factor in the calculations is, when you're about 5-6 years out away from your goal, so in 2035, 2036 onwards, start reducing your equity exposure, because you want to reduce that event risk or the volatility of the portfolio as you're closer to your goal. And perhaps so instead of 15%, if you build in 20% step up in the initial years, that'll be great, because that'll allow you to then build that buffer and kind of de-risk your portfolio in the last 4 or 5 years.
Right. So I think, Jishnu, so far so good. You're at least good on the SIP amount, but then as far as the fund mix is concerned, we will again take your question on the show. But then with this, Kaustubh, it's a wrap. Thank you so much for being on the show and helping our viewers with everything related to their financial portfolio today. And I'm going to leave our viewers with our WhatsApp number and email ID, where we would request you to send us your portfolio-related queries, anything to do with mutual fund or your investment strategies that you would want to decode with us and our experts. You have the WhatsApp number and email ID. Thank you so much for watching. Goodbye.